you are thinking about passive investments, you may have heard me talk about shares somewhere else, because I do a lot of that, investments, both in private equity, venture capital, and also buying and selling of shares, but not as a trader, but as an investor mostly. The difference is that a trader will trade for margins. An investor will buy for value. So you do an analysis of the company. When I'm buying even one share, I am buying the entire company in my mind. I always ask myself, if I'm to buy this company, not a share, would I buy it? Before I buy the share, that's the question I first get to have an answer on. So what you need to do when you are evaluating which investment in a passive manner to invest in, first of all, there are very many categories. Fixed income, there are shares. Fixed income are like bonds, treasury bills, and etc., where you are guaranteed. But everything that you are guaranteed also comes with a very retro margin or very retro yield, because you are risk averse. So being risk averse means you take the gain equivalent to a risk averse person. When you have a high appetite of risk, when the reward comes, you also get rewarded adequately, incommensurate to your risk. But what I look for myself in investments across large T-bills, shares, private equity, number one thing you have to always think about is liquidity. When you are buying land, you are buying shares, you are buying bonds, when you need the money, how soon can you get it? You know, maybe some of you can relate. This Kenya is full of people full of wealth. Wealth, niko na shamba ya eka 200, 200 acres, 2,000 acres, niko na hii. Okay, fine. You've told me how much it's worth. When can you get it? When can you get it? Liquidity is always a very critical thing. And me, I approach life in terms of I also need money. Because I don't think you're investing money for the next 200 years. You're investing money to help you have a good life continuously. So if you can't liquidate your money, then you have to think about it, liquidity. How soon can you liquidate that asset you're investing in? Secondly, always do some analysis about return on equity, return on investments, return on assets, depending. Na mimi nikiangalia hapa hii hall, I don't need to go into details on that. There is something else I always look for in the NSC. I can't buy a share before I look at it, called PE ratio. PE ratio means price over earning per share. So earning per share is what? When the company announces end-year profits, they divide their profit by the number of shares they have. So what they get is earning for every share. So PE measures how the company is trading in the market, that is the NSC, divided by its earnings. You are able to see if the company can pay dividend the entire amount of money, how long would it take me to recover my money? Currently in the NSC, to the best of my ability, the company with the lowest PE, the lower the better. Because the lower shows the least possible time you can get back your money if you have to rely on net profits. If I buy this company, the net profit per year, how soon can I return my money? So it measures a period, PE ratio. I'm just highlighting so that you also go do your own research. Risk profile, as you invest, look at how risky a thing is. Don't delegate some of these things. You know, many times in investments, we want to, you have an investment advisor. These things, you can do them by yourself. It is your money. Remember that all the time. Even after listening to your financial advisor, it's not their money. It is your money. And you realize you don't need so much time to learn. You can actually do your basic analysis using with very little time. Evaluate the company's fundamentals. This is for shares. Fundamentals means look at which sector are they playing in. For example, now, look at areas that are growing, sectors. So by the time you even zero in on a company, where are they zero grazing? Is it a bank? Is it an IT company? Is it an agricultural-based company? So that by the time you decide, you understand why. For example, if I'm to buy any agricultural company in Kenya, the shares, I will never buy for the profit they make. I will only buy for the asset they hold. And I'll only then buy if there is a way I can buy so many shares and cause them to sell that and distribute the money. Because you realize Kapchorwa Tea is one of the listed companies, Limuru Tea, you get Williamson Tea, rich in assets in terms of land. But their profits are always like this. Because agriculture all the time, agriculture is never like this. You make money this time because weather was good. Next year you bump again downwards. So always do that month. If you're doing a company for you to get in substantially, cause the company to liquidate some assets, to pay off a special dividend, it's called stripping of assets. Then I would buy a company rich in assets, but thin in revenue. But in our capital markets now, if you're buying a company or shares, always look for a company making good revenues, but also distributing that revenue to shareholders. So that you look at the fundamentals in that scenario. Their corporate governance, the sector they are based in, how dominant are they in that sector, how much profit do they make, do they have a room to expand beyond the Kenyan market, and such and forth. Maybe lastly, the other thing is timing. And again, I'm going back. This is not for anyone to do for you. Because I can talk here, then somebody asks me, which share can I buy? I can't tell you. Because it's your work to do that. Timing means this. It does not take a lot of time. That's why I'm saying this. I'm not talking about this in bad faith. How does the global economy perform from the US market? After how many years do we have a reset of the US economy? After how many years do we have a reset in the Kenyan economy? So that we know when you are likely to expect a bump, you know when you are likely to expect a growth, when the market is supposed to be bearish, bullish. It does not take so much time. Even Kenya now, you can check when did we have a dip, when did we have a bullish market. Mostly they go hard together, US, Kenya, and globally. It will not take you so much time. Timing. When the market is bullish, it's not a coincidence that the Dow Jones in the US is trading in its all-time high, and the Kenyan market is bullish, South African market is bullish. It's not a coincidence. There is something around something you can do on analysis to put in your money where you need to get it. Lastly, diversify beyond Kenya, both in business and also investments. In business, we seem stuck with the market we already know. My Rotary Club members are the ones, I am building a product with them in mind. No. Build with the global market in mind. Internet came to help all of us, not some of us. So that you are able to open up your mind. And the limitation, most of it is the one you've put in yourself. There are people currently selling very many things anywhere else in the world. So when you look at a product, look at it in that manner. Also in terms of investments. NSE is just one of the markets in the world. There is no barrier to invest in New York, in South Korea, in JSC, in NGX, that is Nigeria. There is no barrier per se. Study, see where the opportunities are, so that by the time you put in your shilling like this, your calculated return will come in almost precisely. Because you are not doing guesswork. You have engaged your mind, you've used data. Thank you very much.
Wow.